Hello, everybody. Welcome to Friday, another Talk Money with Tom show. We try to help you have a more successful financial retirement by answering your questions, asset management, retirement planning, tax planning, etc. So feel free to send in those questions now. You can send them to the email address, asktom@talkmoneywithtom.com. You can put them in the chat box. We'll try to answer those live as they come in. Or you can send them in during the week. We also cover questions that came up during our client strategy sessions that I think you might find interesting also. We believe, very much so, that education is one of the key components to having a more successful retirement, especially financially. So we created this channel to try to broaden the education of our clients and others. And so you can look at the 1,000 videos I think we have on there now. You can subscribe to the channel, hit the subscribe button, and basically go hit the bell button to get notified when we get something new. Or you can just set up a time to talk to Easton and I if you have some questions that come up that are more personal in nature. You go to our website, hit the book appointment button, and basically set up a 30-minute video or phone time with Easton and I, and we'll see if we can help you as far as that goes. So really looking forward to the show, looking forward to being able to see if we can help you today, and appreciate you coming and watching today. As usual, I like to start off the show with just a summary of what I saw happening with the stock market over the past week. A lot going on this year, a lot going on this week. I've got a chart here of the S&P 500. You can see, the red line is kind of a trend line, is obviously on the downside. The blue line there is the 200-day moving average, which we're below, and we have, been below for some time. And so one of the things we look at when we're looking at stock markets is what we call the primary trend. And so the primary trend is either up or down. And then in this particular case, the primary trend is definitely down. And there are a couple of key things you look at there. Are you hitting lower lows over time? The answer is yes. Are you hitting lower highs? The answer is yes. Are you below the 200-day moving average? Yes, we are. Is the 200-day moving average going down? The answer is yes. So what we are doing right now is we're investing with the primary trend, which is investing to the downside. So we've got our model portfolios are set up so that we have money in an inverse position that actually goes the opposite direction in the S&P 500. If you're trying to invest to go up, there's been 5 different cases where the market's gone up this year, but all of them have failed, and that's why we call that the minor trend. The rest of the money that we have right now in our models is in T-bills and ultra short-term bonds. Really, this is what we want to do until we start to see a change to a primary trend to the upside. And then we want to get back into our normal models and basically go on our way as far as that goes. And we'll talk about kind of how we got there. And so, first of all, let's talk about some of the things that happened this week. I'll change this to a scene that you might be able to see better. We had the job openings come out this week and actually grew a lot. It was kind of surprising. We're supposed to have 9.8 million jobs, which would have been kind of continuation from that peak and continuing down. This is what the Federal Reserve wants to see. They want to see less job openings because there's almost 2 job openings for every 1 unemployed person, and that creates inflation because they have to pay more and more to get those people to come to work. Well, lo and behold, we ended up with 10.8 million jobs that were reported open last week, which was 1 million more than expected. So market struggled. Actually, we were down every day this week, and this was part of the reason why. And then today we have the jobs report that comes out. So this is looking at what happened with the jobs for last month. And so you can see there's 261,000 new jobs created in October. Well, the expectation was 195,000. So that's kind of more jobs than expected. And again, normally we want more jobs, not less jobs. But in an inflationary environment, more jobs creates more pressure on inflation, which ultimately makes the Federal Reserve raise rates more than they are, which ultimately makes stocks, bonds, and real estate suffer. And so we'd like to see the jobs report come in at expectations or lower in terms of being able to say, okay, we're starting to turn the corner. I will say, if you look at this chart for the last 12 months, the number of new jobs created is on a downside altogether. And so, again, that's something the Federal Reserve would be looking at as a positive. But today was sort of a negative in that regards. we have workforce participation, which is down for the month. It went from 6.3% to 6.2%. I know that doesn't seem like much, but actually every 0.2% is millions of jobs and people, basically. And you can see that it was over 63% prior to the pandemic. And so this is one of the problems. People are not coming back to work at the same rates, yet we have all these jobs and this growth in the economy, and it's creating a very tight labor market, which is inflationary. And so that is a bit of a problem as far as the Federal Reserve is concerned. We did see, and this is kind of an interesting chart, the green line there shows how much year over year the hourly wages increased. And you can see what happened in 2020, when things fell, et cetera. And then the gray line there is the consumer price index. So one of the problems we're having right now is that costs are going up faster than wages are going up, which creates a tighter situation, creates problems inside of industries. Luxury goods might have a difficult time doing well here. People are looking more for, the necessities as far as that goes. But if you do look at it, that 4.7% growth in October, it's down a little bit. That trend, peaked out more or less when the CPI peaked out. So again, actually, the market would look at this as a positive because we need to have softer growth on wage increases. If wage increases continue up and up and up, that means the companies have to pay more, which means that they're going to pass that or try to pass that along in higher prices, which makes higher inflation. And they call that wage price cycle, the inflationary cycle. And if they don't increase their prices, then they lose earnings, right? They compress their earnings, and earnings are one of the biggest drivers for the stock market. So this is actually a really important component. When this report came out this morning, the market actually jumped 2%. As we speak right now, it's all the way back down to basically where it started. And that is because if you really look at the whole report, there's a mixture of different things that have happened as far as that goes. And then lastly, the report showed the unemployment rate actually grew. It was supposed to be at 3.6%, and it was at 3.5 last month, but it grew to 3.7%. And so again, unfortunately, in this environment, that's seen as a positive for the stock market because again, it shows some softer aspect of the stock of the labor market, which is we have two real problems for inflation. One is supply chain, trying to get things through, get it from China, wherever it is. The other is labor, trying to, get things done or delivered or serviced or what have you. And so having a softer employment situation is going to be better from an inflationary standpoint. Now, when Chairman Powell spoke on Friday after the Federal Reserve meeting, he talked about this is a hot job market, very strong job market. And again, when they're talking about that, that's not a good thing in the sense that means they feel they can raise rates more and more and more. And actually, specifically at that meeting, he talked about the fact that they felt like they were going to have to go to a higher peak rate than was expected the month before in the previous meeting. And that was the point when the stock market dropped. And we ended up down 2.5% on Wednesday after the question and answer period that they had. And so this reports altogether are showing, I think, kind of a tight labor market. It's softening up a little, which is a good thing in terms of the stock market, but not a lot yet. So that's going to be really interesting to watch how that plays out. We had one other really interesting thing happening this week, and this is a chart from iShares. This is a China ETF. And so you can see it's down a lot, right? I mean, it's, the 200-day moving average line there is basically down at what, pretty good clip. But there's a big jump here that's happened this week, and that's actually affecting things. We're seeing big jumps in the European market today. This is up 6% today. And so what happened was there was kind of a rumor / social media post that talked about reducing the zero COVID policy and kind of reopening China, which is kind of ironic because at the same time we've locked down Shanghai, Disney. We've had this Foxconn plant area closed down, and all because of COVID cases. But the market has been running with this, even though the government came out and said, well, no, we really haven't changed our zero COVID policy. We're going to, see some run here, partly because I think it's really down a lot. before this happened, before that rumor came out, I saw a lot of analysts saying, hey, it might be time to start accumulating Chinese stocks. This is something to watch. I know it's not here in the U.S., but if this market takes off, sometimes these big markets can kind of carry other things with it. So we'll see what happens. I will say that emphatically the government over and over has said that the reason that they have to use the zero COVID policy is because they don't have enough hospital capacity to take on a large surge of COVID cases. And so, they're going to be in this cycle until they figure that out. They add more hospital capacity, or they come up with some other, start using a different vaccine, and there is some talks that happened about the possibility of using, say, the Pfizer vaccine in China. So, of course, that would take some time, right, to get out. You got to get people to do it and those types of things. But those could be positive developments. But something to watch here that we don't normally talk about, but I think is important. So we have talked about this before. The leading economic indicator is down. The blue line there shows the leading indicator. The gray line shows the actual economy. If you look closely, the blue line comes down before the gray line, right? And we just came down a lot since February, but it can be kind of early. So if you look back to the 2008 downturn, which is the big gray bar there, that was topped in October of 2006. The bottom of the market wasn't until March of 2009. So again, this is one of the reasons why we are being conservative, because this is projecting a recession. And then this week, we got another piece that came through. Probably the most accurate projections for recession is the inverted yield curve between the 3-month and the 10-year. So in this particular case, what this chart is showing is this negative 0.11%. What that means is that the 3-month T-bill is paying more than the 10-year Treasury, which is pretty incredible if you think about it. So you can give the government your money for 3 months, make more money than you would if you gave it to them for 10 years. And the reason that that is inverted is because the expectation for the bond market is that the future is going to be soft, right? The recession is coming. And when this inverts, the average time to recession is 12 months, so say October of next year, although it can be as short as 5 months and as long as 22 months. This is actually a big study that the New York Fed did on this inversion, had a 94% accuracy rate for a recession, as long as that inversion continued for 2 to 3 months. So, it's just starting, but it is a big deal that it did invert here as far as that goes. So, one of the questions then is, okay, great, market's in a downturn, the primary trend is down. How do we know when one of these things isn't the big turnaround, right? Because look at how many, I'll put some arrows here. Look at that. So we have all of these green arrows were bottom points where theoretically you could have said, okay, that's the bottom. Now we're going to come back up. And all the red arrows are where it failed, where it stopped. And so we've had 5, right? Including the one that we just had in October, which was a 13% run from that low to the high point that happened. And so how do we know when one of these is going to be the one that really runs, gets through that 200-day moving average, and we turn this primary trend back into a positive instead of a negative trend? And really, I think the number one thing you have to take a look at there is the 2-year Treasury yield, okay? So if you take a look here, this is the yield on the 2-year Treasury over the last 12 months. It was a little less than 0.5%, 12 months ago. Now it's a little bit more than 4.7% in that range. And so all the way through, and if you go back and you look and you say, okay, take that green arrow, look at where the 2-year Treasury was, and then when it gets to that top point, was the 2-year Treasury higher or lower than it was at the green arrow? Every point there, it was at least the same, if not higher. So what the market's telling you is the stock market's making these runs. You got short covering, you got all these different things, you got dip buyers. But as long as interest rates continue up, and this is basically a projection of what the Federal Reserve is going to be doing, you are going to probably see those runs fail. We need to see the 2-year Treasury fall in yield at the same time that the stock market's running, in my opinion, in this environment, before we should really be excited about this particular run-up. And so then you ask, okay, how do we know when the 2-year Treasury is starting to turn over? Some basic concepts. Got some trend lines in here. You can see those red lines. It's very steep, right? I mean, it's not curling at all right now. It's going straight up pretty closely. We got that blue line there. It's a 200-day moving average. Maybe we get back down to that. These are some basic things. Another basic is just a moving average crossover. So the purple line there is a 10-day moving average. The red line's a 50-day. When the 10 crosses through the 50, right? Maybe that's a point to be, out of the, being back into the stock market, because we're starting to see that long position. So a combination of the stock market, moving up with the 2-year Treasury kind of curling over to the downside is really what I would be looking for here. Prior to that, the risk is quite high. And I think there's going to kind of play out a couple different ways. Either inflation's going to continue, because we keep seeing core inflation go up. It's supposed to be going down. It's been going up. PCE, which is the measure that the Federal Reserve likes, or CPI, in both cases over the last couple months, core inflation has been going up. And so you're going to have to kind of finally get that to come down slowly but surely. They're going to continue to raise rates. And, we could have this long period of time where we're trying to fight that. The other way is that they're raising rates, they're trying to fight this, and then something breaks. Mm-hmm. And then all of a sudden, boom, and so that Lehman Brothers moment, and something happens out there because of these higher rates and the higher dollar that creates an economic crisis, essentially, a financial crisis. That brings the rates down fairly quickly, probably as they try to fight that crisis and go the other direction to try to support things. Might also bring down inflation as people start to pull back on their spending in that financial crisis, much like they did in 2008. So, that would accelerate things, but you're probably talking about a much bigger stock market drop too, probably in the neighborhood of 30% from where we are, possibly, because of that breaking. So it'll be very interesting to see how this plays out, but those are the things that we're looking at right now. That's kind of my outlook on what's happening. We did get some good news this week in terms of the jobs report, I feel, but there's enough bad news in that jobs report that probably keep the Federal Reserve going on the interest rate increases. And, we have to just continue to watch the yield on the 2-year Treasury. I think we'll get a better idea for what's happening. So, yeah, so that's what's going on today, and we'll make sure we cover this again next week. Why don't we move into our questions?
What does next week's midterm elections mean for the stock market?
Oh, that's a great question, actually. Let's go. I have a chart here we can share. I think it's quite interesting. Okay, so here is a chart that goes back from 1962 to the last midterm, which is 2018. Mm-hmm. And that dark, I guess, blue, almost purple, black line is the average rate of return on the market, the S&P 500, over those midterm years. The lighter blue line is this year. So kind of interesting, actually. There's a fairly strong correlation between what's happened so far this year and what's happened on the average year of a midterm. But look what happens once the midterm kicks in. You get a really big run-up, mm-hmm. right? And so why is that, right? Normally what happens in a midterm year is that whatever party might be in control, which right now is the Democrats, they have the House, the Senate, and the White House, one of those pieces turns to the other party, mm-hmm. right? Right now, via the polls, maybe it's the House. Who knows what's going to really happen? We'll find out, after next Tuesday, hopefully. But nonetheless, what is happening is that then things don't get done. Mm-hmm. And I know it sounds kind of weird, but so whatever that one party has when they have full control, they might be able to pass more regulations, change taxes more, do things that, make change. Now, as a business, let's say, you're Apple and you're doing your planning on the next version of whatever it is and it's years away. You'd like to have less change because in an environment where there's a lot of change, it's very difficult to decide how much money to invest in these different projects. Where you have less change, you can maybe be more confident and invest more money in those different projects. And so one of the weird things about a midterm election is that it generally creates a bifurcated White House Congress scenario, which creates less happening in terms of bills and regulations that might get passed, tax changes that might get passed. There could be different things that can happen, and we'll see what happens. But BlackRock, which is the biggest money manager in the world, with the iShares and these different things, has come out and said that they don't feel we're going to have this pattern this year. Because what's different this year versus the 1962 through 2018 is the combination of the war in Ukraine, the inflation rate, and the pandemic, which is shutting things down in China. And they feel that those overwhelm the advantages that the market might see in a bifurcated Congress. So this is going to be very interesting to see what happens, but you can see that there is a very strong seasonal play to the upside that's coming at us starting next week. And so, our position right now is to be out of the market except for these inverse positions. Obviously, if the market moves this way, that hard going upward, that's going to be tough on our portfolios. I don't know if it'll happen. I don't know if we'll have the run up, but maybe we go sideways more than we would have, just because we have that seasonal to the upside, and then we have the Federal Reserve and inflation going the opposite direction, pushing to the downside. Maybe those opposing forces are fairly equal. BlackRock thinks they won't be equal. They feel like the Federal Reserve motion and what's happening with interest rates is more powerful than the advantages of a bifurcated Congress. So really fascinating. It's a really good question, to see how that works out as far as that goes. Got a lot of other things. What happens with the debt ceiling? Is there a big argument over that? Does that create problems for the stock market? What happens with the actual election? Is there a lot of contested elections? What does the market do with that? Those types of things. So next week we're going to find out, where these things are going. So.
Yeah, on average, 1 year after the election or the midterm elections, you usually get 14.8% return. So It's a very strong trend.
It is. It's a very strong seasonal trend, and there aren't a lot of really good things you can point to that have a good trend. A lot of things are really messy. The midterm election trend has been quite strong, so it's something to be aware of going forward here. All right, what is our next question?
What are your thoughts on IBONs with their new rates? So the new rate is 6.89%, which is the combination of the inflation rate and the fixed rate, and now there's an actual fixed rate of 0.04%.
Yeah, we have a chart for that. This is showing the IBON rates in blue there. Going back a little bit before, going back to 1998. And then you can see that fixed rate, actually, that black line there. And so what has happened here, so those people that bought it at that peak that just happened, that was 9.6 or something like that.
Yeah.
They get that rate for 6 months, correct? And then it'll adjust down depending on what happens with the rate. So these I-bonds, you can buy, $10,000. You have to go directly to the Treasury to do so. You can buy more than 10,000 depending on, registering different entities. Your trust could buy 10,000, those types of things. There's some, I don't know all the details, but if you have a refund coming.
Yeah, you can buy an additional 5,000.
Another 5,000 if you have a refund coming. So you have to overpay your taxes to make that happen. And so anyway, it's a little bit limited as to how much you can put into them. Let's put it that way. And they can obviously drop down in rates. You have to leave them in for a year. So this should be money that you don't need for 1 year. You can't take it out. Treasury doesn't allow that. If you take it out within a 5-year period, then there's a 3-month interest penalty. So whatever you would make in 3 months in interest, they take that back.
Yeah, the last 3 months of interest, you lose that.
Yeah, so again, probably should be longer term. You can leave it up to 30 years, right, as far as that goes. And so I guess that's the question, are rates still going to be high over the 5-year period? So you're kind of making some guesses as far as that goes. I don't really have a problem with I bonds in terms of doing them. I think they're probably a good idea. Personally, though, with the level of wealth that we're dealing with within our clientele, the amount of money that you can put into these just isn't going to make. I mean, you can run a financial plan on somebody who has $2 million or $5 million, and they're able to put in 10 or 20, 30, 40,000 in these. It's not going to make much difference, even if it does pay 9%. And then you have to open up all these different accounts, and you have to go directly to the Treasury to do it. And I don't know, it's an interesting piece. If it wasn't limited and you could put more in there, boy, that would be a really interesting play.
Yeah, it's how much you want to work for your money too.
Yeah.
And the nice thing about I bonds too is there's no state or local tax; they're tax exempt, and also you can have it set up so that you only have to pay taxes when you actually realize it. So there's no or you could decide to have phantom income if you want to. So you have those options too.
Yeah. So we get lots of questions and emails about the I bonds that have been coming in. So that's why we're addressing it here in the show too. So very fascinating area altogether. All right. Now what's the next question?
I have some extra cash in my accounts. Should I be looking to buy 2-year Treasury bills?
Yeah, so we've been talking about 2-year treasuries a lot, right? Have a chart for that. And so, here's the yield on the 2-year treasury over the last 12 months. Again, it's gone from, roughly a little bit below 0.5% to right around 4.7% now. So you can go out and buy a 2-year treasury, and as long as you hold it to maturity, you're going to make 4.7%. So should you do that is the question. I guess I don't have any real problem with it. It's a good way to make 4%. It's very safe. It's backed and guaranteed by the U.S. government. I guess my question would be, if you look at this trend, it doesn't look like it's abating. It's still going up. And so you're locking in at that rate for 2 years. I might rather go with something like the 3-month Treasury, which is pretty close to this at around 4.1%. That way I get my money back. If rates go up, I'll be able to continue to, push that into something at a higher rate. There is a chance, though, that the advantage of doing 2 years versus, 90 days is if something breaks, then rates could come down, and you'd be happy that you got that 4.7%.
Yeah.
Does that make sense? Now, if rates continue up, the value of your Treasury bond will actually go down, right? And so, yes, you're going to get 4.7%, but the value is going to go down in between times if rates go up. So you have to make sure you don't need the money, or you could actually lose money on this because you have to sell it in between times, which you can do. They're very liquid. But you get your money back, what you paid for it at the end if you hold on to it till the end. So some of the criteria. I think one of the competing thoughts I would have here, though, is a money market fund. The Schwab money market fund right now is a little bit over 3%.
Yeah.
Fidelity's right in that same range. Not quite as much as the 2-year T-bill, but that 3% actually is before this last rate increase, which was 0.75%. And the money markets seem to be pretty much following, at least from what I've seen recently, whatever the Fed funds rate is, which is right now 3.75% to 4%. So I wonder, with a money market fund where the price doesn't change, it's at $1 a share. If that doesn't make more sense over the next 1 or 2 years, if rates continue forward, it's also super simple. No cost. You get money out. You don't have to worry. If you need money in between times, you can get it because the price stays at $1. The safety of a money market mutual fund is not the same as the safety of a Treasury bond, right? Treasury bonds, direct obligation with the U.S. government. That's about as safe as you can get. A money market fund is not. So, you got to consider that. Generally speaking, money market funds have done really well, and that $1 price has held up, but it is part of the consideration.
What do you think about laddering? So let's say I have $100,000 of extra cash.
Yep.
What if I buy, $20,000 of the 2-year now, and then maybe in a month or two I buy another thing? So doing multiple kind of.
Yeah, well, the traditional ladder would be, let's say, take 20,000 and you'd buy a 3-month, then 20,000 you'd buy a 1 year, 20,000, you'd buy a 2-year, maybe, it's not a traditional ladder, but 20,000 into the money market fund. And the idea behind the ladder, and they do this with CD ladders and what have you. So that 3-month comes due, I would go out and buy another 3-month or something too, or that 2-year comes due, I come out and buy another 2-year. And it's a way to kind of spread the difference in terms of your risk of, rate as far as that goes. Laddering works great. You are starting to add complexity to the overall scenario, which is sometimes an issue. But yeah, I think laddering could be another good solution there too. But it's a very interesting area. I'm having conversations with clients, and so I wasn't really paying much attention to any of these T-bills or T-bonds. Yeah, because they weren't paying
anything for a
right?
while.
I mean, this was paying 0.43% a year ago. Who would pay attention to that? I mean, the market's out there, you have a better chance. But now, see, it's starting to pay closer to 5%. And I suppose there's some possibility here that this thing's going to get to 5%.
Yeah.
The projection right now for peak fund rate by the futures market is 5.25. And so this could get up to that level, too. That's why the stock market struggles when rates go up. There's a viable asset class alternative to taking the risk of the stock market. You can put money into these different bonds and lock in and get these great rates. And now the stock market has averaged 11%, but at a lot more risk, versus what you can get in a Treasury bond. And that is why higher inflationary environments are more difficult for the stock market to deal with. Yeah. So it's a good question. All right, what do we have for our next question?
What is terminal interest rate? We've heard it a lot during Fed discussions and kind of Fed meetings, so that'd be interesting to know more about it.
Okay, so I have a chart for that. Oops, let's get Eason in here. So in this particular case, this is the futures market for the Fed funds rate. And what this is looked at is kind of the projection for what the peak interest rate might be. In this case, sometime next year. And a little hard to see this, but right now it's at about 5.1%. It actually hit 5.25% today, this morning. So again, right now the Fed funds rate's a little bit of a range, 3.75 to 4%. And so what they're saying here is that it could go to 5.25, which is actually a lot more than the Federal Reserve had projected in their last summary of economic projection, which was 4.7% back in September. And Chairman Powell actually alluded to that in this meeting without saying any numbers. The next summary of economic projection comes out in the next meeting in December. They only do those every four times a year. So we'll see what they come up with their projections. Oftentimes, the Fed has actually been quite wrong in their projections. This futures piece has actually been much more accurate, because there was a point in time, even September of last year, where the Fed said they weren't going to raise rates at all in 2022, yet this futures thing had a projection that they were going to be raising rates quite a bit, and that turned out to be true. So when they talk about this peak piece, it's kind of important. Chairman Powell, Federal Reserve Chairman Powell, talked about there's three main things: how fast they raise the rates, how high they end up getting to, kind of that peak rate, terminal rate in this case, and then how long they keep it there. And so the focus has been on pace. Everybody's talking about what's going to happen in December, and he said the pace is no longer that critical, in his opinion, because they've already come quite a ways. He says it's much more important to focus on the peak and then how long we might keep it there. And so this is showing the peak terminal rate projection, and this is something to follow, as long as this thing continues to go up like this. And you can see that 200-day moving average, that blue line there, this is going straight up, right? As long as that continues to go up, the stock market is going to have a really hard time going from a primary trend down to a primary trend up, right? So this is a chart that I watch, just like the 2-year Treasury, and they're very correlated, actually, if you lay them on top of each other. But just because until this turns over and there's some expectation that interest rates have peaked or coming down, this terminal rate is now going to be the thing we probably talk about more than the pace. Are they going to do 3/4 or a half or a quarter? What? It might not matter that much because we're already close to this terminal rate. Now, I will say this terminal rate's still going up. right? And so it went up last week. It's been going up last month. And so the terminal rate might actually be higher than 5.25 before we finally get there. And so the Fed thinks 4.6, 4.7. They may end up going to 6 because inflation has been quite sticky and because we've seen that core inflation continue to come up. So it's a really good question too.
Yeah, one way to think about the interest rate on the Fed is the Fed's steering a cargo ship. So, and interest rates are kind of like your steering wheel. You can turn that steering wheel as fast as you want, but that cargo ship is still not going to turn on a dime. You still got to take some time to turn that ship.
Well, yeah, that's really interesting because during the question and answer session from Chairman Powell on Wednesday, that was exactly asked. They call it the lag. So how are you accounting for the lag? Because you're raising rates right now, and you don't really know, what's going to happen to the economy. The projection's usually around 6 months before they really see the impact of the economy. And so shouldn't you be pausing or slowing down just so you can see what the impact is? And he said something very interesting. He says that was very true in the past, even back in the kind of the 2008 timeframe. He says, but what's happening now is a little bit different. The market is responding so aggressively to everything that they even say that the lag may be reduced quite a bit. So a good example would be the fact that mortgage rates have already gone up tremendously, right? I mean, from around 3% to around 7%. And well before they were starting to even raise rates, we started to see mortgage rates come up. That's the market responding. The two-year Treasury's at 4.7%. Theoretically, it shouldn't be when the Federal Reserve rate's at 3.75 to 4, but it's responding in advance of what it's seeing. And so that could create less of a lag, right? Where that cruise ship or battleship or whatever you want to call it might turn a little bit faster than expected. I thought that was really interesting commentary from him. All right. Looks like we have a chance for another question.
So, what happens to RMDs when someone passes away during the year? So, someone's taking their RMDs and then they pass away without completing them.
Yeah. So let's say your spouse or parent or what have you, and you're the beneficiary of that retirement plan, IRA in this case, and the person that was the owner of that was over 72, and they were required to take money out of their retirement plans every year. You don't have to take it out at any point in the year. You can take it out by the end of the year. So let's say somebody passed away in June and hadn't taken it out yet. You still have to take it out.
Yeah, you still got to satisfy that RMD.
Right. And then, and so that's a part of the process that we usually deal with in transferring that retirement account over to the new owner, is satisfying that required minimum distribution first. Oftentimes there's more than one new owner if there's multiple beneficiaries in there. So we get the RMD out of there first. That's part of the estate tax, final tax return. And then essentially you distribute the IRA or divide it up after that as far as that goes. So and it used to be that you had to continue to do a required minimum distribution as a beneficiary. They used to call it a beneficiary IRA. Well, they still call it beneficiary IRA, but the rules have changed. So now you do not, at least as we speak at the moment, you do not have to do a required minimum distribution, but you have to take it all out by the end of the 10th year.
Yeah, as long as you're not like one of those exceptions that you're allowed to use the stretch. But
that's right. You can use the stretch. There's several exceptions, and that's a whole nother show. And actually, we did cover that. You can find that on our channel because there's a 5-year. There's where you don't have to take anything out in 10 years because you're within 10 years of the age and your sibling. And there's a whole bunch of different things that are out there. Obviously, as a spouse, you get all the money. You just keep going on your own program. But in essence, it has changed, and it's just something to be aware of. It used to be fairly standard. Everybody had to do a required minimum distribution. And now there's a lot of people that fit into that group that have to take it out within 10 years, which is, kind of a really interesting thing. Very interesting tax planning aspect of what happens, because if you've got some kids and they're going to inherit a fairly big IRA, it could be quite dramatic on their tax return to have that money, hitting there as far as that goes. Yeah. So it's a good question.
So, as the midterm elections near, there's been a lot more ads attack ads, and we've seen some talking about, Republicans may cut Social Security benefits. Is this kind of an empty campaign threat, or is this kind of something that's actually going to happen?
Yeah, it's really interesting, right? I mean, there has been some conversation even from some Republican senators about the viability of Social Security, and that if we continue to go down the same path, that we will have a scenario where, there's all kinds of problems with Social Security. The overall government debt is, being pulled down by people living longer and more money coming out for Social Security. With the reality of it is that Social Security is incredibly important to the retirement community, and making cuts to that is, they call it the third rail in politics, right, or what have you, where it's almost impossible to imagine that they'd be able to do something to the current group. The stats are kind of amazing. I remember reading something that $49,000 plus Social Security is what the average retiree has. So that's not a lot of money, especially in an inflationary environment. And be able to cut back on Social Security on a current basis, right, for current receiver of Social Security. But having said that, they have already cut back on Social Security many times. This wouldn't be the first time, because of basically what they've done is they've moved the age out. So my father, his retirement, what they call the full retirement age, FRA, it was 65, right? For me, I'm 58 now, is actually 67. So that's a cut. That's a cut, because if I was my father and had my earnings, I would actually get more money quicker, because the age. And so, they've modified Social Security already to make it more, robust. Probably need to modify it again, because again, people are living longer and longer, and we have this weird bubble with all the baby boomers kind of retiring, and we'll have not enough people behind them to kind of pay into the Social Security system, because it's a pay in and pay out system, right? So they've already talked about moving the the full retirement age out to 68 or even 69. So maybe my kids have, even longer till they get to full retirement age. That's a cut.
Yep.
That's going to happen, in my opinion. Whether they do, I mean, it already has happened, so it's kind of obvious that it could happen again. Whether they do an actual cut to, Social Security for current recipients, I would be stunned by that. I don't think that's going to happen. I think that's more of a political issue than anything, certainly to get people motivated. But it is interesting to see how it's going to be handled, because it's not being handled yet.
Yeah, and there's other things they can do. You could change, when the payroll tax caps out at your FICA taxes. There's a cap on that right now. They could take off that cap or increase it to $200,000. So the current generation is paying more money in. Or they could be more aggressive with their investments. Right now, those investments in the Social Security system is very safe. But, maybe they just become more aggressive. They add a little bit more equity to that, and they could compound their returns that way.
Yeah, they've already talked about and proposed an unlimited cap, where it doesn't matter, because just to describe what the cap is, basically, I don't know what the dollar amount is this year, 140,000 or 50,000, I don't know, some 170. Once you get to that level, you no longer have to pay Social Security taxation. And so that cap goes up each year a little bit. That's why we don't know the number off the top of our head. But the situation then is that you can have it unlimited. So if somebody made $10 million a year, like some people do, they would have to pay Social Security taxes on the entire $10 million. That would obviously create a lot more revenue. That got proposed because it's kind of popular. Hey, let's tax, the wealthy to try to support Social Security, and it doesn't really affect many voters, which is important. And so, the other thing that I've seen is the possibility of modifying or even eliminating for future generations the cost of living increase, which I don't know, that would be really crazy. Right now, it's going to go up 8.7%, and inflation has gone up a lot. If you took that away for future generations, it would make a difference. There would obviously have to be it would be great if they combine that with some other programs where people could save at a higher rate, or even forced to save at a higher rate into like a 401k. And there's been some proposals for that too. So, because they're trying to take some pressure off of Social Security. All right. Well, that's our show today. Thank you so much for coming. I really appreciate it. Hopefully, everybody got something that they can grab onto here and use to help themselves with their retirement. Again, feel free to subscribe to the channel. This type of education isn't out there many other places, so this is hopefully could help you. You can hit the subscribe button, hit the little bell next to it if you want to get notified. And if you'd like, you can sit down, on the phone or video with Ethan and I. You go to our website, hit the book appointment button, and we'll sit down with you for 30 minutes and answer your questions directly. So I want to thank everybody so much for coming today. Again, we'll look forward to seeing you again next week. Thank you.